Is multifamily the next domino to fall? Some folks that are losing properties and foreclosures, but is multifamily the next thing that's going to be just like office, where it's like, oh my goodness, it's crashing? This is the Cash Flow Digest. My name is Matt Faircloth, and me and the DeRosa team are here for you guys on a weekly basis with this podcast, YouTube video, and broadcast recording. This is also live on our Facebook group, DeRosa Insiders. In whatever medium you're watching, please take a minute and like this content, leave a comment, and leave it a review. We really appreciate you guys doing that. We're going to be talking about all things real estate and all things cash flow because our company is dedicated to transforming lives through real estate, and cash flow can do that. We're going to be talking about things that are affecting the real estate industry, news in the real estate investing world. And we're also going to be bringing on guests that are crushing it in the cash flow sector of real estate investing. If you guys want to join and watch the show live, please go to Facebook and look up DeRosa Insiders and join that Facebook group where we record this show every Friday at noon Eastern. Hope to see you guys there. What is going on, DeRosa Insider? It is Matt Faircloth here. Thank you guys for joining us for the Cash Flow Digest show. I am super pumped. Give me a big thumbs up, a big love on whatever vehicle you guys are watching this on. If you guys are not on Facebook, our DeRosa Insiders community, what are you waiting on? Go to Facebook right now and go to DeRosa Insiders. Join our free capital F free community. We're all about just giving value. It's a free community that we post all things real estate on, including this show getting broadcast live on that channel. And you guys can ask questions live. You guys can maybe even come on and join me as a guest live on the show at some point in the near future. So guys, I want to talk about something happening in the world right now. There's a lot of talk about commercial debt coming due, and that's on office and retail. We talked about office and my theory on this is Matt's opinion on how real estate investors can take advantage of the changing office environment with regards to occupancy and debt. Right? So make sure you check that out from last week's show. But today we're going to talk about the big question. Is multifamily the next domino to fall? We already are about some folks that are losing properties and foreclosures. But is multifamily the next thing that's going to be just like office, where it's like, oh my goodness, it's crashing. Oh my goodness, there's such low occupancy, or properties going bankrupt and going to foreclosure. Some of you guys that are, want to be the sharks of the industry and kind of look for fresh meat in the water, maybe hoping those kind of things happen. But first of all, you don't want to hope that happens, because what that does is that pulls the value down everywhere. And so if you guys go and get lots of great deals, you're not going to be able to do anything with them, because you're not going to be able to, you're not going to get valuations to refinance them. You're not going to be able to sell them or anytime soon or whatever. So you're going to be stuck just like everybody is now with assets. You don't want to hope for a crash in multifamily if you're a multifamily owner or new buyer. Here's what I believe is going to happen with regards to multifamily, and how I think the changing finance environment is going to affect the multifamily world, right? Let's talk about a few different asset classes first. Let's start with Class A. Right. Class A is what I call like bougie, brand new built, like within the last 5-10 year multifamily space. A lot of folks either built new multifamilies and are holding them, or bought new multifamilies that were built recently. The thing about Class A is most Class A asset classes were bought on agency debt, because you can. They're typically high occupancy. You rarely see anybody buy a Class A brand new build on bridge debt. And if they did, shame on them, but you're probably going to see it on fixed rate debt. The Class A investments that are out there are going to be, for the most part, good to go, because they're on fixed rate debt, hopefully longer term. The ones that are going to have problems were the ones where the owner went in, the new buyer went in, and maybe paid too much. Shocker that people paid too much for multifamily the last couple of years. And then you couple that and then overpaying for the asset. And if you overpay for a property that you can force appreciation on and make go up in value through increasing NOI, increasing rents, and doing a well-effected business plan, right? If you overpay for a property, you can business plan your way out by increasing NOI, by making it worth more through your own efforts, right? But if you couple somebody overpaying for a property versus them being on time lay on top of that, somebody being too aggressive with their business plan and saying, oh yeah, I'm going to push rents 15%. I'm going to drop expenses 10%. I'm going to, integrate all these new improvements. Is going to make the property worth double what I paid for it. Not for nothing, I've seen other operators' projections and said that show that they're looking to double property value in the next couple of years on a new construction asset, just through their own efforts, not through the market going up. I don't think that's going to happen. I don't think that big value add on Class A is going to work. Again, this is yet again Matt's opinion, is that the market, I think, is fairly saturated on rent bumps. You're not going to see 10, 15, 20% rent bumps or anything like that anytime soon. I think we're where we're going to be for rent for a while. And the other side of that is how do you boost NOI? Pushing rents, reducing expenses. Okay. If you got a new construction property, odds are expenses are kind of where they're going to be. You can't you're going to make the toilets more efficient. You're going to stop water leaks. No, it's new construction. All that's been addressed already. So expenses are probably where they're going to be, and rents are probably where they're going to be too. So if you have that correlation of two things, of a Class A asset that was overpaid for with an aggressive business plan to push rents, those people that have that little perfect storm that they've created on their own, they are not going to be able to sell or refinance at numbers that are going to make sense in the next couple of years. If you look at assets that were bought over the last 3 years and they were bought on 5-year debt, that debt's going to be coming due over the next 2 years. So you're going to see those folks probably have to sell at less than they projected that they wanted to, maybe less than they wanted to sell for. They probably bought it on interest-only debt the whole time because that's just what works these days. So that's the first asset class is going to experience trouble in multifamily. Now, not everybody bought with that perfect storm, but keep an eye out, guys, for properties that were bought several years ago that were bought overpriced with aggressive business plans. They might be going back to the bank because they're overpriced. Number two, this is probably what you've heard the most about, which is bridge debt, right? A lot of people that bought properties under bridge debt. We did too. Guess what? Everybody did. People talk, oh, it's the big sin. They bought it under bridge debt. Everybody was doing that. Okay. That's what you do to make it work. So the problem you're going to see with bridge debt on properties is people, yet again, overpaid on property. They went in with not a good enough business plan, increase their rents over time or increase their occupancy or increase their NOI, right? They didn't go in with enough money, with enough of their own money or enough of their investors' money to invest in the deal and to deal with the rate cap issue that's come in on bridge debt, right? Not pounding our chest, but at DeRosa, we're a little more conservative than some other operators. So we had plenty of cash. So as rate caps start to come in and get more higher priced, thankfully, lucky enough to be able to deal with that as those changes have come in. Not everybody has. And so you're going to see properties that were bought on bridge debt where they either didn't have enough cash to keep the asset going, enough cash to buy the rate cap as the rate cap has gone way up as compared to what it was because interest rates have increased. Also, they maybe were expecting the property to be worth a lot more because they're expecting the party to keep going, so to speak. They're not going to be able to get out of their bridge debt, and then they're not going to be able to refinance or whatever it may be. So you're going to see people going back to their bank with hat in hand, perhaps looking for other finance solutions to get them out of their deals. But these are people that just went in a little too aggressive, with bridge debt on deals, right? Those are the two that you're going to see the most of. Those two things are not going to crash a market. They're just not, because there's a bunch of other stuff out there that doesn't qualify for those little two perfect storms that I just described, right? Got it. So the other one that you're going to just see maybe come up is people that have refis due. Here's the thing: multifamily debt is not like 30 years. No real commercial debt is. It's like 5 years, 7 years, those kinds of things, right? So if in general owners can't refinance their properties that they have debt coming due on, then sure, they're going to look to sell and maybe look to sell at an aggressive number. But far and away, most multifamily owners are not the knuckleheads that got in a couple of years ago. These are people that have been doing this for a while, and they probably have low loan to value ratios. They didn't refi and pull every nickel they could out of these properties. They're going to refi and maybe pull a little bit out, a little bit less out than they wanted to, maybe cash flow a little bit less. But far and away, multifamily owners that constitute like the 80 to 85% of the multifamily owner population of the United States, when their debt comes due, they'll just pull out a little bit less, just marginally decrease what their loan proceeds were going to be, and they're going to be just fine. right? It's that other 15%, the Class A stuff and the, super aggressive bridge debt stuff. Now, you're not going to see all this hit the market all at once, just like it did during the housing crisis in 2008, because it's just not going to be like a bottom dropout thing. If you want to buy assets like I just described, you have to be very, very granularly focused on a market, not 7 markets, not 32 markets. If you guys really want to do well in the next couple of years, pick a market, one. How many? One, right? Become an expert on that market. And then as those assets that I just described start coming due, and they will, then the brokers know that you, not the person down the street that's shopping 22 markets, are the ones that they should call to do a nice, discreet, off the market sale for somebody so nobody gets embarrassed and you guys can just take that transaction. That's the only way you're going to get great deals, is by super granular, focused on specific markets. Okay? So that's what I got, guys. That's my 2 cents. Offer ideas for potential market conversations you want me to have with you guys, for Matt to break out his crystal ball again and offer up his unsolicited opinion on what's happening in the real estate market. Please write a comment in whatever medium you're watching this vehicle on. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.